My name's Chris Gosselin. Today we're talking to Sarah Shaw from 4D Infrastructure, part of the Bennelong Group. And as the name suggests, Sarah invests in global infrastructure in both developed and emerging markets. Sarah, welcome.
Thanks for having me.
Sarah, can we just start off by talking about the major drivers, or let's call them headwinds or possibly tailwinds, that are affecting the infrastructure sector?
Sure. Look, I may split that if I can between fundamental headwinds and tailwinds and clearly the sentiment that's driving equity market performance for the sector. And if I start with the latter, clearly infrastructure or listed infrastructure is considered by many as a bond proxy. So the interest rates and inflation dynamics of the last sort of 12 to 24 months have certainly not played in its favour. And sentiment has been weak for the sector on that bond proxy trade. But then if I look to the fundamentals, infrastructure offers so much more than a bond proxy exposure. I think it offers really attractive defensive characteristics, which gives you very long-term, visible and resilient earnings, which is a very attractive foundation for the asset class. But what I'm really excited about is the long-term growth thematics. And these are thematics that are fundamentally in play and that are going nowhere, regardless of what happens to inflation or interest rates or GDP or a geopolitical landscape. These thematics must happen. They are huge and they will drive the sector's growth and underpin the valuations for decades and decades to come. So yes, while short-term cyclicals and interest rates and inflation has certainly impacted the sentiment for the sector, the fundamentals remain incredibly solid, and we think it's a great opportunity to use this disconnect between sentiment and fundamentals to gain exposure to a rapidly growing asset class.
So those, you mentioned gaining exposure to the asset class at the current time. Are you able to do that at a price you think is undervaluing the asset in the long term?
Absolutely. I think the weakness in the asset class over the last 12 months has certainly provided investors a really attractive entry point. We are seeing long-dated assets with really strong growth tailwinds trading at valuations well below average and well below fundamental fair value. So it's a great time to be actually entering the sector, particularly since the near-term tailwind is ultimately probably interest rates moving back down. We think that we have reached the peak, so the next move is down. We don't expect to get back to 0% rates around the world, but certainly we'll see declines from here, which will be a sentiment tailwind, but you will have also accessed really attractive fundamentals at a very good price.
Sarah, the infrastructure assets that you particularly are focusing on, are there some styles of interest or types of assets that are more attractive to you at the current time?
Look, it was a very easy call last year. We were very much focused on the subsectors within in infrastructure that compounded and capitalized on the inflation dynamic. And for us, that's the user pay sector, such as toll roads and airports and ports. Last year, we were very heavily overweight to those user pay inflationary compounding assets. However, this year it's a little bit tougher to call because we are seeing that interest rate dynamic shift and we're sort of seeing inflation come back. And because the utility sector or the essential services sector was so weak last year, they are now offering very competitive value and they will benefit as a tailwind as interest rates shift down. So we have reweighted a bit this year to increase our exposure to more utilities out of some of the names that performed extremely well last year as they captured the inflation and the volume story.
So within the actual portfolio, it sounds as if you turn it over, but you don't necessarily trade it. So you turn it over to meet the way the market is moving or trends within the market, but it's not a trading type strategy.
Absolutely not. Our philosophy is to give investors access to the best opportunities globally within listed infrastructure, but with some credibility or to taking note of where the market or the economic framework or environment is. So we do a huge amount of due diligence on stocks before we actually invest in them. We are investing them with a thinking behind it of a 5-year hold. We use a 5-year return profile as our investment horizon. So we're certainly not thinking this is a trading portfolio. However, we do like to capitalize on the short-term cyclicals as well as the long-term thematics. So to that end, if we think that there is a cyclical shift in any country or globally, where the valuation of the infrastructure names also stacks up on a relative basis, we will capitalize on it.
Sarah, can I just turn to emerging markets versus developed markets? So you have two funds, one emerging, one developed. Do you have a preference at the current time? Do you think there's more opportunity in one than the other?
I think there's 5 huge growth thematics that are within the infrastructure landscape. One, first and foremost, is developed market replacement spend. Okay, so that's clearly a developed market thematic. And that's just replacing our very old, aging infrastructure. And if we don't do it, we're going to have social and economic consequences. So the second big thematic is population growth. And that's with the East getting younger and the West getting older. Both of those dynamics require different sorts of infrastructure spend. So they're both a developed and an emerging world growth thematic. The third big thematic is the emergence of the middle class, largely in developing economies. 85% of the global population is in the emerging world. So to see the evolutions of those economies is going to demand so much in the way of infrastructure investment. The fourth big thematic is the energy transition. The developed world is very fast tracking the energy transition and investing heavily. But to be honest, our goals of net zero or a 2-degree reduction are going nowhere if we don't bring the emerging world along with us. As I said, 85% of the global population lives in the emerging world, and their energy consumption to date is 1/3 of the developed world. So unless they come through this journey to green with us, then net zero is definitely not achievable. And then the fifth big thematic, again, I believe is global, and it's a rise of technology. We're hearing so much about AI and data centers and technology advancement, and it's a really exciting thematic, but I can tell you it's going nowhere without infrastructure investment. Unless we have communication towers in place, and unless we invest heavily to get security of supply in the electricity grids and into generation, then AI sort of dies a very fast death, because you can't evolve the technology space without huge investments in electricity and communication towers. To answer your question in a very long-winded way, I think that global and developed and emerging all offer huge opportunities in different ways. I think exposure to both is fantastic. The reason we have a dedicated emerging market infrastructure strategy is because it is an amazing thematic. The growth is enormous. And also, I do believe it is by far and away the greatest or the best way to gain exposure to emerging markets. You get access to the in-country domestic demand stories. It's all driven by the domestic demand. You're getting actual emerging market growth, but you're hedging key risks of emerging market investment, including sovereign risk, because they need the infrastructure deployed, and inflation, because you get an explicit hedge. So if you can get exposure to the emerging market growth thematic, but hedge key risks, to me, that's by far and away the best way to gain exposure to the emerging market equity markets.
Sarah, that's sort of a segue into ESG, because the whole climate issue and ESG are obviously connected. Do you have a specific ESG strategy or thematic, or you just wrap that into everything that you do?
Yeah, look, sustainability, ESG, whatever terminology we want to use, has been incorporated into our process since day one. We have a 4-step process, and it comes into play at every step of that process. And that's basically on a screening basis in terms of country screening as well as stock screening. It comes into our stock analysis at both a qualitative and quantitative level, and it comes into a portfolio construction level, and in terms of output to make sure our portfolio is tracking in the right direction. For me, it's not a separate strategy. It's not a separate theme. To me, it is integral into any investment proposition. You want all of your portfolio managers to be investing in sustainable companies, sustainable businesses.
Sarah, unless there's any other questions you have of me, that's really interesting. I think the infrastructure, the whole concept of infrastructure, as you say, is a long runway, if I may use the pun when it comes to airports. But it is a long thematic that's just got to happen and has got to play out. Thank you for your time. Look forward to speaking again soon.
Thanks very much, Chris. Great to speak to you.